If my personal experience is anything to go by, the first question you probably get when you start talking about cryptocurrencies with friends and family is, what the hell is cryptocurrency? Well, here's how I answer that question. Put simply, cryptocurrencies are like regular currencies, except they're entirely digital. Each individual cryptocurrency coin is fundamentally just a collection of numbers and letters. This sounds complicated, but it's actually not far off from what we see with currencies today. Here's what I mean by that. Almost every physical money bill on the planet has a unique serial number. This serial number corresponds to information like when the bill was printed, where it was printed, and so on. In theory, a record of all money bills that have ever been printed and where they are is kept by a central bank, which shares this information with smaller banks and the government. If you have a debit card or credit card, you'll know that you have an account number on there as well. You also have a password or PIN number that you use to access the money in that account. Your bank branch knows your account number and your name because you had to provide your personal information to open an account. This info is also shared with the central bank and government. Now, let's say you have a $20 bill with the serial number ABC, and your bank account number is 123. When you deposit that bill into your bank account, your bank branch, the central bank, and the government will see and confirm that the $20 bill ABC has been moved into bank account number 123. This is almost exactly how cryptocurrencies work. Each individual cryptocurrency coin is like the serial number you see on a physical bill, just without the physical bill. Just like regular bills, almost every cryptocurrency can be divided into smaller pieces. In the case of Bitcoin, each BTC can be divided into 100 million pieces called satoshis, which are like cents to a dollar. A cryptocurrency wallet address is like a bank account, except there's no physical card that goes along with it. It's just an account number. Because you don't need to provide any personal information to create a cryptocurrency wallet, this means that your identity is not attached to your crypto wallet like a bank account is. Most importantly, any cryptocurrency held in your personal wallet is held directly by you, not custodied by a bank like regular money in a bank account. This means that nobody can shut down your cryptocurrency wallet or block your transactions because you have total control over that account at all times. Now, the trade-off here is that if you lose access to your cryptocurrency wallet or forget to write down the recovery phrase you get when you make one, well, you'll lose your cryptocurrency forever. Instead of banks and the government keeping track of everyone's bills and bank account balances, these records are stored across all the computers connected to a cryptocurrency network. These transactions and account balances are public and can be viewed by anyone using something called a blockchain explorer. Because computers can earn cryptocurrency for processing transactions on a cryptocurrency network, this incentivizes more computers to join the network to process transactions and earn cryptocurrency. This makes cryptocurrency networks secure because there is no single point of failure. This is called decentralization, and it's the polar opposite of the centralized setups of governments and banks. Now, in case you didn't put two and two together, that means the digital currencies banks around the world are creating are not cryptocurrencies. They're creating a seriously dystopian payment network. Once you've blown their minds with that analogy, you'll probably get questions about Bitcoin and Dogecoin and any other cryptocurrencies they've heard of. Here's what I would say. While you've probably heard of Bitcoin and Dogecoin, there are actually thousands of cryptocurrencies, just like there are hundreds of different regular currencies. US dollars, euros, Chinese yuan, and so on. The crazy thing is that every cryptocurrency is different, and not all of them are designed to be a currency you would actually use for everyday transactions. Broadly speaking, there are two types of cryptocurrencies: coins and tokens. Now, cryptocurrency coins belong to cryptocurrency networks that were built from the ground up. And by from the ground up, I mean that someone spent a lot of time and a lot of money putting together the code required to create a safe and reliable cryptocurrency network. Cryptocurrency coins are the cryptocurrencies given to computers when they process transactions for a cryptocurrency network. For example, BTC is a cryptocurrency coin because the Bitcoin network was built from the ground up, and BTC is given to the computers that process transactions for the Bitcoin network. Because cryptocurrency networks are so hard to make from scratch, only a few dozen cryptocurrencies are actually coins. The rest are cryptocurrency tokens. In contrast to cryptocurrency coins, crypto tokens are easy to make and can often be created in a matter of minutes with little to no effort. This is why there are tens of thousands of tokens. The NFTs you keep hearing about are actually cryptocurrency tokens that are like digital certificates of ownership for physical or digital art pieces. NFTs are just the tip of the iceberg of what you can do with tokens as well. For example, there's a company called Circle that issues a cryptocurrency token called USDC. USDC is fully backed by real US dollars, which means that for every one USDC in circulation, Circle has $1 in the bank. You can create USDC by giving them your dollars and redeem your dollars with USDC. Another company called Paxos issues a cryptocurrency token called PaxG. Each PaxG token is backed by 1 troy ounce of gold kept in a vault here in London, and you can redeem PaxG tokens for real physical gold or US dollars. The best part is that both Circle and Paxos are fully regulated in the United States and regularly audited to make sure they have the appropriate number of reserves on hand backing their tokens. How's that for security? Now, speaking of security, the most important thing to remember about cryptocurrency tokens is that a lot of them are nothing more than scams. This is primarily because cryptocurrency tokens are so easy to create. All a scammer needs to do is create a token, set up a fancy website, pay for a few ads on social media, pay a few news outlets to feature their shitcoin, and they can get rich off crypto noobs overnight. Naturally, the next question that crypto-curious compatriots are likely to croak is a timeless classic. Are cryptocurrencies safe? After all, I heard they're used by scammers and criminals, and I keep reading about all of these cryptocurrency hacks. Well, this is usually my response to these sorts of questions and comments. Whether a cryptocurrency is safe or not ultimately depends on the context. For starters, not all cryptocurrencies are created equal. Some cryptocurrencies are built to prioritize speed over security, and usually the consequences of that play out quite quickly. Luckily for us, there are always hackers somewhere looking to crack cryptocurrency networks so they can trick them into creating new coins or tokens out of thin air to sell for a fancy profit. Now, this might sound scary, but it's no different to what happens to banks and corporations on a daily basis. When hackers succeed, the affected company usually beefs up its cybersecurity. The same goes for cryptocurrencies. This means that most cryptos that have been around for years are robustly battle-tested as a consequence of always being under attack by bad actors. If you're not convinced, well, consider this. As I mentioned earlier, some cryptocurrency networks are made up of computers spread out around the world that are constantly double-checking transaction histories and account balances. If you wanted to corrupt a cryptocurrency network, you would have to hack more than half of all the computers connected to the network at the same time in order to do it. This is impossible to do if you have a cryptocurrency network like Bitcoin that has millions of computers spread around the world. That said, some cryptocurrency networks have fewer computers processing transactions and are therefore more vulnerable to attack. The same rule applies to centralized cryptocurrency services like cryptocurrency exchanges, which is where most crypto hacks have happened. These are much easier and more lucrative to exploit than an individual cryptocurrency wallet, which is insanely secure. That's why you should always keep your crypto on your own personal wallet wherever possible, and only keep it on an exchange when you're trading or cashing out. And when it comes to self-custody, nothing beats a hardware wallet. When it comes to criminal activities, it is true that ransom demands made by hackers often involve some kind of cryptocurrency. While the cryptocurrency these hackers demand is often Bitcoin, they almost always exchange that Bitcoin for a privacy-oriented cryptocurrency like Monero as soon as they can. This is because Bitcoin and most other cryptos have publicly viewable transactions and wallet balances. This makes Bitcoin transactions very easy to trace by authorities, even more than regular currencies. So it makes no sense for criminals to actively use and hold a currency that's so easily tracked. Cryptocurrencies like Monero are completely private, and even the US government can't crack its encryption, which is seriously impressive if you think about it. In sum then, the overwhelming majority of cryptocurrencies are not used for criminal purposes. There are just a handful of cryptos that are actively used by criminals. The real risk when it comes to crypto relates to investing. Cryptocurrencies are extremely volatile, meaning their prices can go up or down by up to 50% in a day. Investing too much in crypto can be extremely dangerous, especially when you push your luck with something called leverage trading, which basically uses borrowed money. That's why you should only invest what you're willing to lose and not a penny more. Not financial advice, of course. Assuming it hasn't been asked already, the next question that will land in your lap will be along the lines of, why are cryptocurrencies so volatile? What gives them any value to begin with? Here's my counter. What gives the money in your wallet or in your bank any value? Now, once upon a time, it was backed by gold, but that changed, and since then, all state-issued currencies around the world have been losing value. This is because the only thing that backs dollars and euros is ultimately the trust we have in the governments that issue those currencies, and that trust has been eroding for decades. Not only that, but governments have been actively printing and manipulating their currencies to benefit themselves and the corporations that fund them at the expense of the average person. This has caused record levels of inflation that incentivizes spending over saving, which leads to overconsumption and causes the sort of environmental catastrophes they claim to want to stop. Cryptocurrencies are valuable because of what they do. Obviously, this value changes depending on which cryptocurrency we're talking about. Bitcoin has value because its BTC coin has an economic profile similar to gold. It has a maximum supply, and only a small amount of BTC is created each day, and that amount is cut in half every 4 years. Assuming demand for Bitcoin stays the same over time, this would lead to a doubling of Bitcoin's price every 4 years. However, demand for Bitcoin has increased over time as we realize how weak regular currencies can be, and this awareness has been enhanced by the current pandemic. As basic economics dictate, when something has a limited supply but the demand for it continues to increase, prices inevitably rise. Many investors also see Bitcoin as a safe place to park your capital outside of the current financial system, including me. One important thing to note is that most other cryptocurrencies are highly correlated to Bitcoin, meaning their prices are reliant on what BTC does. Even though that's the case, some cryptos such as Ethereum have insane value due to the utility they provide. The Ethereum network can be used to create those cryptocurrency tokens I was talking about earlier, and you can even create decentralized applications and websites that can't be censored or shut down. All transactions related to creating and moving tokens and interacting with these applications require Ether to pay for gas fees. This means the demand for ETH rises as the Ethereum network gains adoption, and Ethereum has seen some serious adoption. Visa is testing payments on the Ethereum network using that USDC token I mentioned earlier, and the European Central Bank even issued a bond on the Ethereum blockchain. Now, the reason why the value of BTC, ETH, and every other cryptocurrency fluctuates so much each day is because basically nobody knows what these technologies are actually worth. The prices of stocks and gold and even regular currencies fluctuate every day for the same reason. But cryptocurrencies are much more volatile because what they do is revolutionary. Cryptocurrency networks make it possible to lend, save, and borrow without an identity, credit score, or bank. They make it possible to do business directly with other people without a middleman taking a cut, meaning service giants like Uber and tech giants like Facebook could become obsolete. They make it possible for communities to pool their funds together and vote on how they should be spent, which could eventually cut out the needs for governments and their crooked politicians. You could even say that cryptocurrencies are the equivalent of a powerful alien technology that threatens the dominance of the powers that be. Now, this potential makes the average crypto investor very emotional. The slightest possibility of a clampdown on crypto results in a market crash, and the most outlandish rumor can lead to a massive market pump. In the longer term, however, you can see that crypto is growing, and that growth is unlikely to stop anytime soon. Now, by this point in time, you've probably more or less convinced your cohort that crypto is pretty legit, and that means there's only one question they have left to ask you. Which cryptocurrencies should I buy? Well, before you answer that question, you must remember to emphasize that nothing you tell them is financial or investment advice. Otherwise, you could end up in court if their crypto investments go south. And even if you're legally covered, you could still find yourself eating a knuckle sandwich or two if your guidance directs their greed to a financial gutter. That's why I usually respond with the following. Which cryptocurrencies you decide to invest in boils down to your timeline and risk tolerance. In terms of timeline, the cryptocurrency market seems to follow a 4-year cycle. We're currently in the bull market phase, which is where prices gradually rise. The crypto bull market could end as soon as this fall and as late as early 2022, and the likelihood that you will sell your cryptocurrencies when they're at their highest prices is slim to none.